Amsterdam, 1637. The floor of the Amsterdam Exchange is crowded, loud, and anxious. A trader stands near a wooden column, gripping a thin sheet of paper. A futures contract for a single tulip bulb. That slip of paper is worth more than the house he grew up in, more than most people will earn in their lifetime, and definitely more than an actual flower should command. Across the hall, another trader refuses to honor his contract. He doesn't shout, he doesn't run, he just shakes his head. And the deal evaporates. There is no king to enforce it, no soldiers to resolve it, no official to take notes or impose order. The price simply collapses, right there on the trading floor. A market that felt unstoppable suddenly forgets how to stand. For the first time in history, a financial machine breaks not from war, not from plague, not from famine, but because innovation outran human behavior. If that sounds familiar, you've probably been alive during any year of modern finance. And this moment matters, because the Dutch didn't just create a bubble. They created the architecture that still runs the world. London used it, New York used it, Hong Kong uses it. Every financial empire since the 1700s has quietly followed a Dutch blueprint. The same incentives, the same leverage, the same trust-based mechanics. When today's markets feel chaotic, or self-correcting, or irrational, you're not watching something new. You're watching a 400-year-old design doing exactly what it was built to do. But to understand the architecture, you have to understand the problem the Dutch were trying to solve. The Dutch Republic had no king, no gold mines, no sprawling empire supplying endless silver. What they had was water, a lot of water, and a culture built on negotiation, contracts, and mutual survival. They lived in a land where flooding wasn't a disaster. It was the norm. If your neighbor failed to maintain a dike, you didn't get annoyed. You got wet. So Dutch governance evolved around a simple rule: cooperate or drown. It created a population unusually comfortable with shared risk, shared costs, and shared decision-making. The perfect petri dish for modern finance. But there was still a structural problem. Trust does not scale. A merchant in Amsterdam could trust his neighbor. He could trust the notary down the street. He could even trust the canal to freeze when it was supposed to. But trusting a ship captain sailing to Java for 2 years? Trusting that captain not to lie, cheat, smuggle, or die? That required something bigger than personal reputation. Globalization existed. Zoom calls did not. So the Dutch created something entirely new, a system designed to scale trust farther than any individual could. The VOC, the Dutch East India Company, wasn't just a company. It was the world's first engineered financial machine. Permanent capital meant investors were locked in for the long haul. This wasn't a quick voyage. This was a financial organism. Tradable shares meant you could exit your investment without killing the enterprise. It was risk sharing, not risk dumping. Delegated management, separated ownership from operation. That had never been done before. Until then, if you owned a ship, you typically captained it, or you chose someone you knew personally. The Dutch said, no, the owners will be many, the managers will be few, and the system will keep running no matter who retires, dies, or gets seasick. This was capitalism, before capitalism had a name. But the real shockwave came from what these mechanics allowed. Because once shares existed, they could be traded. And once they could be traded, the Dutch, being the Dutch, immediately created secondary markets, forward contracts, futures agreements, early forms of options, and even standardized clearing processes. All in the 1600s. The first modern financial market did not appear in London or New York. It appeared in a city sitting below sea level, protected by windmills and paperwork. And here's the micro hook most people miss. The Dutch didn't invent speculation. They invented the ability to speculate without touching the real world. You no longer needed to sail to Asia to profit from Asia. You could stay warm in Amsterdam, buy a slip of paper, and call it a day. It was financial efficiency. It was also the beginning of a structural side effect that still defines markets today. Belief becomes an asset, As liquidity grew, a new sensation swept through the exchange. Volatility didn't feel like danger anymore. It felt like opportunity. Information moved faster than ships, rumors moved faster than information, and price moved faster than both. Profit detached from work, value detached from goods. And the market became a reflection of psychology, not cargo. If you've ever watched a stock jump 10% because of a tweet, you already understand the Dutch blueprint. Markets were discovering that once you made risk tradable, emotion became tradable too, and that leads directly to tulips. Tulip mania wasn't really about flowers. It was about a question: can a system survive when trust, leverage, and liquidity detach from real economic output? The VOC's tools, futures, options, leveraged bets, were tested on a commodity that didn't matter. A flower with no industrial use, no strategic value, only status and scarcity. The Dutch weren't irrational. They were curious. They were testing the limits of the machine. As prices rose, contracts multiplied. People were trading bulbs they had never seen, using money they didn't have, based on prices no one could verify. And then one person refused to honor a contract. Then another. Then another. Liquidity didn't decline, it disappeared. And the system discovered its first fundamental truth. Systems designed to spread risk also spread panic. Systems built on trust collapse the moment trust evaporates. Tulip mania didn't destroy the Dutch model. It completed it. It showed exactly where the blueprint would fail, and therefore exactly how it would evolve. It was the 17th century version of a stress test, minus the helpful press conference afterward. And while the Dutch were learning this in real time, Britain was taking notes. Britain didn't criticize the system. They adopted it. The VOC informed the British East India Company. The Bank of Amsterdam inspired the Bank of England. And the Dutch bond market, the first place where governments could borrow against future taxes, became the engine of British warfare. Amsterdam had solved the problem of long-distance trade. Britain solved the problem of global empire. Same incentives, same mechanics, same blueprint, just scaled up, militarized, and backed by a navy. Financial imperialism wasn't invented in London. London just added more cannons. And the blueprint kept evolving. Amsterdam to London to New York to global markets. Each new center solved a new problem. Amsterdam solved coordination. London solved imperial finance. New York solved industrial capital. Modern markets solve scale, the ability to move trillions with keystrokes. Every financial empire inherits the architecture. Everyone adapts it. Everyone eventually discovers the limits built into it. Innovation creates liquidity. Liquidity creates speculation. Speculation exposes the weak seams. Crisis forces adaptation. The blueprint migrates to the next place that needs it. It isn't a moral cycle. It isn't a collapse cycle. It's a problem-solving cycle. And here's where the story turns toward us. Calmly, not predictively. Today's markets still run on Dutch assumptions. Risk should be transferable. Leverage should accelerate growth. Trust should substitute for metal. And markets should self-correct through failure. These are not modern ideas. They're 17th century engineering, layered with technology and scaled globally. Look closely, and the structural echoes become impossible to miss. Liquidity still decides who survives. Leverage still amplifies everything, the gains and the losses. Speculation still becomes democratized during easy money periods. Trust still disappears faster than regulators can react. And despite every advance, high-frequency trading, global clearing, algorithmic pricing, we still depend on the exact same thing Amsterdam depended on: someone else honoring a contract you cannot enforce yourself. Technology accelerated the blueprint. It never replaced it. So here is the Dutch blueprint, distilled into one clean framework. Necessity creates innovation. Innovation creates liquidity. Liquidity creates speculation. Speculation reveals the system's limits. The next empire copies the model and outgrows it. This isn't doom. This is evolution. The real question is not, will the system collapse? The real question is, What problem was our current financial system actually built to solve? And does that problem still exist? Because when the problem changes, the blueprint moves on. If every empire inherits this architecture, adapts it, and eventually outgrows it, which part of the cycle do you think our global system sits in today? Not emotionally, but structurally. This is Money Margins. Thanks for watching, and I'll see you next time.